Hi, I'm Erica Bresslars. Welcome to the pension meeting. I call the meeting to order. Please stand if you're able for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Walt, could you call roll call?
Yes. Frank DeCristofaro.
Present.
Sarah Innamorato.
Here.
Kimberly Joyce.
Here.
Jennifer Liptak. Corey O'Connor.
Amy Wise here on behalf of Corey O'Connor.
Sarah Roca.
Here.
President Bruslers.
Present. Do we have any public comments?
We do not.
No public comments. The President's update. Earlier this morning, we had a working group on plan funding and modernization meeting, and the consultant may be popping her face then, Sarah Emmons. So if she does, we'll introduce her. Next, we move on to board approvals.
So the first set of board approvals will be a motion to ratify the approval of the board meeting minutes for the September 18th, 2025 board meeting.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? Motion passes.
The next motion is a motion to accept the financial statements, which include the pension fund assets, the statement of changes in plan net assets, and the RBAC balance sheet for August and September 2025.
Move. Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? The motion passes.
The next is a motion to approve the November invoices totaling $347,492.66.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? Motion passes.
Okay, next we'll move on to pension applications. The first will be a motion to ratify the approval of the October 2025 applications. There were 9 early voluntary, 4 full retirements, 1 disability, and 28 recalculations.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor?
Aye.
Aye. Any opposed or abstaining? Hearing none, the motion passes.
The next motion is to approve the November 2025 applications. There were 5 early voluntary, 10 full retirements, and 1 recalculation.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? The motion passes.
Okay, the next section will be the independent medical examiner opinions for disability application approvals. The first will be a ratification from October, and the second will be a new approval. The first is a motion to approve that member 102581, upon the recommendation of the 3 designated physicians, is totally and permanently disabled from any gainful employment in Allegheny County.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? Motion passes.
The next is a motion to approve that member 101307, upon the recommendation of the 3 designated physician, is totally and permanently disabled from any gainful employment in Allegheny County.
Motion.
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? Motion passes. Next, we have reports. Director Szymanski.
Thank you very much. If you turn to the Directors tab in your board books, we'll go over some highlights on the dashboard before the approvals and drafts for the following month. Retiree payroll is up 4.9% or 4.29%. We're approaching the $13 million payroll amount a month. We're up to 12.7. Contributions made are up almost 6%. Total membership right now between active, pays, and deferred vested members is 13,004. If you turn to the next page, total retirements for the month are down 3.5%. Full retirements are also down 25%, and early are up 25%. Pension estimates are climbing. I believe more county employees are using the pension calculator, which is very helpful, and I think they enjoy using it. And also to make note, we also did a test run with the retirement portal that the ACRA members are using right now, giving us feedback before we start rolling it out next year to all of the retirees.
Great.
Capital calls as of the last board meeting were 1.7 million. And just to make note as well, the BlackRock Liquidity Fund has been wound down, which Chris will probably address as well. So that was transferred over to cover payroll costs. And the budget as of October 31st is there. Are there any questions on the dashboard section? No? Okay. So I'll move to the board approvals. In the September meeting, after an RFP, we had the Case Sabatini proposal for the auditing services. So we're asking for a motion to approve that proposal. We're for a 5-year contract. The amount listed below would be for 25 through 29, starting at $18,500 with a $500 increase each year, with the last year being $20,500.
Motion?
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? None, the motion passes.
Thank you. The next is a motion to approve the acceptance and vote on Appeal 2025-1. This appeal in which the board, having received and reviewed the report and recommendation from the hearing officer, vote on whether to approve and adopt the proposed findings, conclusions, and recommendations of Appeal 2025-1 denying the appeal.
Make that motion.
Second?
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye. Any opposed or abstaining? Motion passes.
So the next on the agenda will be board updates. The draft 2026 budget is included for review. If there are any changes or suggested edits, please let me know. We'll bring the final budget to the December meeting. The proposed 2026 board meeting dates would follow a same schedule as this year, with 2 meetings per quarter beginning in February. And then there will also be the proposed extension of the Snyder Downs contract at $3,500 per quarter. This is to have tax assistance as we're still working through the software and getting it, completed. And then there will also be a proposed extension of the Coriac maintenance contract. We are going to suggest a 2-year contract at the current rate of $200,000 per year. That also includes the capital call portal. And then all of these items are just proposed for this meeting, but will be brought back in December to ask for approval.
Does anyone have any questions or items for Walt? No, thank you.
Thank you.
Next, we have our solicitor's report from Brian Gabriel.
Thank you, Erica. The solicitor's report is dated November 14th, 2025. I wanted to start by mentioning on the first page under New Matters, subsection A with hearing officers, that is to highlight for the board the fact that we will make a recommendation next month for the appointment of 1 or 2 or so new hearing officers for 2026. And so we had received, at the time of this report, 3 letters of interest with 3 resumes. Those have been attached, are attached to the report for the board's review. I did receive another one yesterday, and we can circulate that as well. The second item I wanted to mention, if you look to page 5 of the solicitor's report, I'm sorry, page 4 of the report, number 5, that's the district attorney's litigation. There will be a more detailed update next month, but we did have a conference with the court this week and an order from the court regarding the next steps in the case. And essentially, the judge is focused upon a legal issue and is going to limit the proceedings over the next several months to that legal issue, which is a statutory interpretation question, and will ultimately conduct a hearing in April 20th of 2026 on that issue. So we'll have more detail in the next report, but I did want to give that update since it came since this report was finalized. The final item under the solicitor's report is an action item. This is a class action settlement, and a request that the board consider and approve a motion to approve the settlement negotiated by our class action counsel, BLB&G, in the case of the Allegheny County Employees Retirement System versus Adapt Health. That's in the United States District Court for the Eastern District of Pennsylvania at number 23 CV 04104. And a description of that case and the settlement is contained under the shareholder section. That's number 7, page 7 of the report, subsection D, in case anybody needs additional background.
And so today we're floating a motion to approve accepting this settlement offer?
Yes.
Is that correct? Okay. And this is a $35 million total settlement offer? Am I allowed to say that out loud? Should I
That's
say
correct.
that out loud? Okay. Sorry, let me turn the page. Do I have a motion to approve the settlement negotiated by BLB&G in the case of Allegheny County Employees Retirement System versus Adapt Health Corp. in the U.S. District for the Eastern District, U.S. District Court for the Eastern District of Pennsylvania at number 23-CV-04104?
Make that motion.
Got the motion. And the second, do we have any discussion? Yeah.
Do we have any idea how much Allegheny County might recoup from the settlement? I see our losses were estimated at 2.4.
We do not. I think it's fair to say, I mean, we usually get information kind of as they proceed with the formal settlement process. In these cases, our class action counsel, once the settlement is reached, they have to go to the court for preliminary approval, then go forward with final approval, and along the way, or at some point, file motions for additional things like costs or incentive awards for lead plaintiffs, which we are in this case. But to answer your question, I think the short answer is we don't anticipate there being a substantial recovery outside of any type of incentive award that our counsel is able to get, meaning there isn't a separate judgment amount entered for the retirement system, but there are sometimes additional recovery in this settlement process.
And you'll be able to let us know how much, if any.
Yes, and so usually if you look in the, with these class actions, we do report on any settlement and post-settlement development. So for instance, the last class action settlement we went through, we did receive a specific award, not an earth-shattering amount of money, but whatever that amount is, we put in the report. So that will, we will continue to update until the case is concluded.
Thank you.
Sure.
I just had one quick question. Does this sever our ties with this group after we've completed this? Because I thought we had multiple investments with the same group.
Oh, that's
Is this a different one than
this
we?
is that related to the executive session from a
Yes.
month or two ago? This is a different thing.
Okay, got it.
This is a
Sorry.
class action.
I thought it was
Yes.
the same group.
No,
Okay.
and in regards to what I think you're asking about is in the solicitor's report,
Yes.
in the first section, item B and C. And do you want to give a Beaver County update on that one?
I think Chris is going to discuss that.
Oh,
I
okay.
think as far as the legal analysis and the memos, I do think we're going to talk in executive session
Okay.
next month.
Okay,
Thank you.
sorry.
Any other questions? All right, thank you. Did you have anything else?
Nothing else.
Thank you. Next, we have Chris Brokaw and Tim Walters from Mariner Institutional.
Thank you. If you turn to the tab labeled Reports Mariner, the first several pages of the report relate to Rhythm Capital acquisition of Crestline. And so this is deemed an assignment of the contract. Crestline, you have two different investments with them. They're a private equity manager. The one investment is now valued at $12,000. The other one, original commitment of $4 million, it's at $1.1 million. So we recommend consenting to this assignment of the contract, Crestline will continue to liquidate the remainder of the portfolio going forward.
Do we have a motion to ratify the Crestline consent?
Make that motion.
We've got a motion. Do we have a second?
Second.
Hearing a motion and a second, is there any discussion? Seeing none, all in favor? Aye. Any opposed or abstaining? The motion passes. Where'd your mic go?
If you turn to what's numbered page 1 of 151 on the bottom right, so after that first section with that memo, the first memo here talks about raising liquidity. Earlier in the year, we discussed, the board approved the process of liquidating the liquid pension portfolio. And that, because of the ongoing needs of the portfolio, we had been selling that down on a regular basis, and now it's at zero. If you look at the report as of September 30th, it was about $2 million. We put in that final liquidation. At that point, we started the process that we discussed earlier in the year, where I would coordinate, Mariner would coordinate with the pension office to use these cash flow needs to rebalance the portfolio. The summary here is that we raised $10 million from the international equity portfolio, specifically from Bailey Gifford, and those funds were transferred into cash and are being used to meet the liquidity needs in the portfolio. On an ongoing basis, as we go forward, month to month, as cash is required, we'll continue to work in the same fashion and report back to the board at the following meeting.
Thank you.
The next page, page 2, and it's page 2 and 3, discuss a proposed rebalancing. At our last meeting, we talked about the asset allocation and moving some of the allocation that had been in private equity into public equity and fixed income. And so with that adjustment of the target allocations, we're now recommending rebalancing to bring the portfolio in line with the new investment policy. So you see the changes that we are recommending on page 2. Bailey Gifford and Siegel Bryan Hamill are international managers. International equity is now over the target. We didn't change the target. The good news is international equity has performed so well, it has grown outside of its target range. So we're trimming back there. In the private real estate portion of your portfolio, you're also over allocated, and some of that has to do with when we placed some of the investments that were in the private equity portion of the portfolio that are more accurately in the private real estate portion of the portfolio. That caused your allocation to be over its target. So we're trimming back the international equity, the private real estate, and investing funds into the fixed income, specifically CS McKee and Federated core bond portfolios, as well as U.S. equity and State Street and Twin Capital. There's a note there, and it's an important note. The private real estate is not immediately liquid, so we put in the request. It's not going to, like with the stock, the cash isn't going to show up in the next day, but we will work through this schedule as the cash comes in. Page 3, just
I have a
yes.
question about how long do you expect the real estate cash? Like, is that it takes a quarter, it takes a year, it takes as long as it takes?
That's a great question. The short answer is it takes as long as it takes. Another answer is the last time we've requested capital from the Morgan Stanley Fund, it was $20 million, and it came in over the course of, I believe it was 2.5 years. However, what I will say is that the real estate market, as opposed to 2023, 2024, the real estate market is getting a bit more liquid. So that distribution was backloaded. That is the last distribution we got, I believe, was $4 million or so. So I think that it will be less than 2.5 years, more than 1 quarter.
I'm going to write 3 to 27 months on my notes. Thank you. Oh, I had one more question on page 2. In the future, could you have the target allocation, could you include the ranges from our policy statement as well?
Yes, yeah.
Sorry, did I see your hand? Were you trying to get in there?
Yeah, so on page 3, page 2 is direct to the individual investments that are involved. Page 3 lays out the same information, but focusing on the asset allocation to the various asset classes. So increasing the U.S. equity, decreasing the non-U.S. equity, increasing fixed income, and decreasing the real estate. And it's all back to the changes in the policy.
Thank you. I think the executive has a question.
Yes, and actually it might be explained on page 3, but it looks like, according to page 2, we'll immediately be liquidating about $30 million. And then as
That's
far as
correct.
the funds available for investment, it looks like that adds up to $20 million. So where does that $10 million go? I'm just looking at the ones that have the stars next to them.
Yeah,
The liquidation and the new investments.
Yes, absolutely. So what will happen mechanically is I'll work with the pension manager to liquidate 48 million immediately. The 20 from Bailey Gifford, that first line, and the 10 from Siegel Bryan Hamill, 30 will be available essentially immediately. Those funds will then be used to, this is your $10 million question. Yes. So we are going to allocate those to Twin, State Street, and then C.S. McKee.
Okay, thank you.
Thank you.
Oh, do we need to take a motion for it? Oh,
I just wanted to, if it's okay, make note for the record, Board Member Liptak's on the line.
welcome, Board Member Liptak. They've made a rebalancing recommendation. Are we voting on it today? Okay, we omitted putting a motion on the agenda. That's an okay one to add since it's not spending money. Is that a fair statement? Okay. I think I'm looking for a motion to add rebalancing to our agenda, or can somebody just make a motion? Make a motion to amend. Oh, I'm looking for a motion to amend the agenda to add rebalancing the portfolio, to add a motion to rebalance the portfolio. Go team. All right.
Motion.
I heard a motion
I'll second.
and a second. Any discussion? All in favor?
Aye.
Aye. Any opposed or abstaining? The motion to add this to our agenda passes, so I'm adding a little like 3A. Can I have a motion to approve Mariner's rebalancing recommendation?
So moved.
Second.
Hearing a motion and a second, is there any discussion? Hearing none, all in favor? Aye. Any opposed or abstaining? Motion passes.
Yes, sir. Yeah, I know.
There we go.
All right. Thank you. Thank you very much. I appreciate that, and I'll work with the pension manager or director, sorry, to get that implemented. So if we go further through the book, I want to make a comment first on page 7. I'm not going to hit every page, but a few pages here. Not going to dwell on page 7, but what I want to point out is in the third quarter, so the report is through September 30th, this quarterly report, you can see that there's very strong returns in both the U.S. equity market, international equity market, the gold lines there, MSCI ACWI, and in fixed income. So all parts of the public markets producing positive returns. If we turn now to page 16, on page 16, we can see your portfolio assets, and this really reflects back on the recommendation that we already discussed and approved. The new targets from the investment policy are here on the page, and so the recommendation for rebalancing and its subsequent implementation will move those asset classes that are outside of the ranges back towards their range, and the ones that are at the top and above their ranges, those will move back towards their target range as well. So U.S. equity, non-U.S. equity, core bond portfolio, as well as private real estate. What you can also see here graphically is the second line on the chart, the top chart, second line, the liquid policy portfolio. That was $2 million at the end of September, now zero. So that's now been sold out of the portfolio. If you turn to the page 19, what I wanted to comment on page 19 for the quarter started portfolio value, the top line here on the far left, $971.5 million. And you see on the far right, at the end of September, $992 million. And in that quarter as well, about $15 million in net cash outflows, primarily to pay the benefit payments. On page 25, I want to make a comment on page 25 regarding, this is on page 25 and 26, it outlines all of the private equity investments. This is for the year-to-date period. 31 of your funds have made distributions in the calendar year-to-date. We'd like that to be more than 31, and we'd like the dollar amount to be more than 4.7 million. That 4.7 million is on the initial base of 121 million. But I did want to point out that there is progress. However measured it may be at this point. 32, page 32 is the performance. And I mentioned the markets performing well. If we look at the quarter, the top line on page 32, your fund up 3.7 in the quarter and 9.85 year to date. There's a line here. The following line is the total fund excluding private equity. So really looking at the majority of the portfolio, 88% of the portfolio, and most of those assets are liquid or partially liquid, like the private real estate. So that isolates the impact of private equity investment on the portfolio. So overall, when you look at the parts of the portfolio in the quarter or the year-to-date period that have added value, U.S. equity has been relatively strong after years of outperforming international. You see on the next line, non-U.S. equity in the quarter up over 5%, and in the year-to-date period, the international non-U.S. equity up over 26%. So very strong performance in the public equity markets and in the year-to-date period, especially in the international equity. So performance relatively well, relatively good. Private equity, when you go down and look at private equity, that is part of the portfolio that, relative to its benchmark, is underperforming. Questions, comments?
None?
All right. I wanted to make a very brief comment on pages 40 and 41. And this is you could say, a bit of a scorecard for the public markets investments. And you see one manager on watch, Ernest Small Cap Value. It's the first quarter that they are on watch. Long-term good performance, short-term trailing their index. We'll take a closer look at that. Small cap, interesting part of the market now. Emerald, on the flip side, earned almost 20% this quarter. Growth investments have really taken off in this quarter, and value has struggled. Earnest, their investments, value-oriented, have been part of that struggling performance, but long-term good performance. Page 41, this falls into the monitor category. And FNB, the fixed income, we're gonna take a look at that portfolio. Difference between monitor and watch. Monitor looks at 1 and 3 years, and the watch list looks at 1, 3, and 5 years. So we're going to take a look at both these managers, and we'll have commentary at our next meeting.
And could you remind us how long the Federated High Yield has been on the watch list?
Oh, I'm sorry. The Federated High Yield, they were just added to the watch list as well.
Okay. So nothing had been in a status before? Everything was in an okay status before this month?
Yes and no. So the 3 managers that are on watch now
Okay.
were not on watch. There was a manager that was on watch and then went off of watch.
Okay.
Erica, I have one.
Yeah.
So the Federated
Michael?
High Yield, that's different than the Federated Core that we're adding 14 million to?
That's correct. Yes.
I'm trying to see where I can find the Federated High Yield on page 17.
So Federated High Yield.
Oh, there it is, second
Yeah.
from the bottom, okay. So they're at 6, so I'm sorry, why are they on watch? They're, is it against the benchmark? I see their September 2025 yield 6.36. Do we have benchmarks on here at one point in time? Are they no longer there, Chris? Like I thought these are actual yields, right? I thought the benchmarks were.
So on page 34, and sorry, it took me a while
Yeah.
to get oriented.
Okay.
On page 34, if you look roughly in the middle of the page,
Yep.
you see the Federated High Yield. And the benchmark for Federated High Yield, like the benchmarks for the other managers, it shows up below their return. So for the 1 year, the Federated High Yield portfolio is up 6.42%. For the trailing 12 months. The benchmark 7.41, and you can see the same for the 3 and the 5 year periods as well. Federated's return and the benchmark return.
Okay, thanks.
Sure. Those were the extent of my prepared comments. We'd be happy to answer any questions.
You also had were there any other
Yeah.
quarterly performance questions? No, you had one more item?
One more item, iNetworks. So I would say 2 things. One, still in communication back and forth. I know that part of the discussion And I understand targeting the December meeting for a number of items regarding iNetworks. You do have 3 different investments with them. My comment right now refers to the iNetworks Opportunity Fund, which is the oldest investment. The issue at hand, the item on the table, was approving or not an amendment to their agreement, consenting to a 3-year extension of their contract. So that's an item, again, still under discussion, and we'll come back to the next meeting. An item of note that you may be interested in is that Beaver County approved the extension, and they are about 30% of the portfolio. So I know for a fact they approved the extension. I was there at the meeting, and I state it that way because my next statement is I have been informed by the general partner that the remaining 30%, who is not Beaver County or Allegheny County, you are 41%, that the remaining approximately 30% also consented to the amendment and to the extension. So 30%, I know for a fact, the other 30% has been told to me. And if those 2 items are in fact true, then the consent is approved. It's a vote that requires, 1 vote more than 50%. So that's, I think, an item of interest regarding your vote. It appears as if it's already been approved.
Thank you.
Thank you.
Any other questions for Mariner? Thank you so much. Next up, we have the Acrisure team with Brad Rigby, Todd Kordecki, and Amanda, do we like it with a V? Volk? Like Volkswagen.
Is this on now? Yeah, there we go. All right, so in preparation of our 2025 actuarial valuation report, we prepared a demographic experience study to update some of our assumptions that we're using to value the plan's liabilities. We also have some recommended changes for the 2025 valuation included in this material. If everyone can turn to page 3, we have kind of a brief summary of all the material we reviewed and a summary of the impact of potential assumption changes that we're recommending. We reviewed the time period of 1/1/2019 through 1/1/2025. Looked at all the demographic assumptions that we had in place compared to actual experience to see if everything was in line or if things needed adjusted. We largely limited the impact of 2020, 2021, and 2022 because we saw a lot of outliers due to COVID with some of the experience. We reviewed and are suggesting changes to your retirement age assumptions, your disability incidence assumptions, mortality table that we use, salary scale, and marriage characteristics. And we'll go through each of those very briefly as we move along. In the middle of this page is kind of the net impact of all 5 assumptions that we're recommending. The retirement assumption is the only assumption that increased the plan's liabilities as of 1/1/25. And as you can see with the percent changes on the right-hand side of the column, none of these assumptions caused a huge impact to the plan's liabilities. Overall, when we take all 5 assumption changes into aggregate, it's going to impact your liabilities by 0.16%, actually decreasing liabilities by $3.9 million. Page 5, I'm sorry, or wait, page 4. We'll start with the expected retirement age assumptions. We reviewed all 3 job class groups, the police and fire, the sheriff, prison and PO group, and the non-uniform group. Experience for the non-uniform group was in line with our current assumptions, so we're not recommending any change there. The incidence of retirement for police and fire was higher than we expected, but the exposure that was reviewed was so small that we don't feel comfortable recommending a change at this time. We'll continue to monitor that, and if the same situation occurs during the next assumption study, we'll likely raise the decrements for the retirement for that group as well at that point in time. We are recommending a change for the sheriff's, prison guards, and POs group. It was evident that the actual incidence was higher than expected for this group. So we have a little summary table of what the current assumption was, which is the expected column. And we are looking at ages on the left, and then also at 20 and 21 years plus of service going across. So expected, we had 25% assumed retiring at age 55, which is their full retirement age, with 20 years of service. So we went basically from around 25%. The actual results during the study period are in the middle column, really ranging from mostly 35 to 50% the whole way down the age groups. We had more experience at age 55 than the other groups, so we're kind of recommending moving more towards an actual number for age 55 and kind of bumping up a little bit for the later ages as we had less experience there, so we didn't want to go full on to the experience for those later ages. And again, this is for, we also have an assumption for this group with less than 20 years of experience, or less than 20 years of service, sorry, and we're not recommending a change for that specific assumption. This page is now going to apply to only pre-Act 125 hires. Before it applied to all hires, whether they were hired before 2014 or after. Now that we're 10 years, 11 years into Act 125, we believe it makes sense to start factoring in the potential impact of the increased service requirement to the post-Act 125 group, which is kind of what we looked at on the next page for retirement rates. As I mentioned, Act 125 requires an additional 5 years of service to meet full retirement eligibility. And our current assumption is that anyone with less than the full service eligibility will decrement for retirement at a lower rate than those that have met the full service requirement. So you'll see if you look at the police and fire column, the first rate before the slash is obviously lower than the next 2 rates in most instances because we assume that retirement rates will increase as that full service eligibility is met. What we are suggesting for the post-Act 125 retirees is basically a copy and paste of the pre-Act 125 retirement assumption, but pushed back to 25 and 26 plus years instead of 20 and 21 plus years. Does anyone have any questions about the retirement assumption before we move on? No? Okay. The next page is a review of the disability assumption. Our current assumption is quite old, and we actually could not trace back how far it went. So we wanted to update to a more recent table that we could reference and find readily available data on. So we are suggesting an update to Social Security Administration's 2020 projections of disability incidents, their ultimate rates, and we are modifying that table based off a job class. The police and fire will apply 55% of the Social Security table, sheriff guards and POs 35%, and non-uniform is 20%. When we reviewed the data, the non-uniform group had about half of the incidents of what we expected. The other two groups were pretty well in line with our old table, but since that table was getting out of date, we wanted to update it. We really tried to match as best we could that table to our old assumption for the police and fire and the sheriff and guards groups, and we cut the assumption a little bit to try and match actual experience for the non-uniform. Any questions on disability? Okay, I'm going to send it over to Amanda to review the remaining assumptions reviewed.
I get the exciting ones. We're going to jump into slide 7, mortality. So as actuaries, we get really jazzed about this one. But there was a new public table released in May of this year. So anytime a new table is released, we take a look, but we generally recommend updating to the new table that is available. So the new table is the Pub 2016. So we are recommending, the data used in the study is from 2013 to 2019, and it's the most, like I said, most recent one. It actually pulls back longevity a little bit. So initially we were thinking people might live longer, and this pulls it back ever so slightly. Except for one group, so males in public safety specifically, they say that that group will be living longer. So with your population, it pretty much cancels out the effect. So the decrease in the total liability is only 0.12% when moving to this new table, just based on your current population. So we aren't recommending any other changes other than updating from Pub 2010 to Pub 2016. And when I say that, I mean just using the subdivisions and categories that we currently have the 3 groups assigned. So if you take a look at the bottom of the page, non-uniform, we use the general employees, and then police, fire, sheriffs, and guards, we use the public safety employees, and everyone but the police and fire, we use the total data set. So for the study, everybody that was collected, it goes into the rate set. For police and fire, we use above median, which just means the top 50% of members that were in the study would be looked at and used for the rate set. So for employees, that would look at the top 50% of salaries. That would be the group used for that study. And for retirees, it looks at the top 50% of benefits when using that. So we have no recommended changes for there. And then also, you are currently using the most recent improvement scale, MP 2021. That does sound dated, but the Society of Actuaries is pretty much holding steady until they can get a really firm grasp on COVID. We're thinking it's going to either be 2027 or 2028 by the time a new improvement scale. And I see Erica furrowing. So Erica, what question can I address for you?
So the police fire use the above median based on this is a pay-based group?
Yes.
In my head, sheriffs made similar to police and fire. Was that just like wrong?
You are way closer to the data. I'll pass to Todd.
I would need to go back and review
Oh,
it.
great. Okay, thank you.
Erica, we'll take a look and we can
Okay,
follow up
yeah.
via email about that one.
Were there any other questions so far? Thank you. Keep going.
Okay. All right. On page 8, we took a look at salary scale. As Todd has mentioned, COVID really did have a big impact on certain aspects of the study. The salary scale was one of them. So only years 2019, 2023, and 2024 were used when we were taking a look and compiling the results. So if we just move down to the chart below, it's set up extremely similarly to the retirement and disability charts that Todd previously walked through. So the expected, what we were expecting that was in place and on the current assumption, The actual is what we saw. And then you can see we have 2 buckets now for the recommended change for salary scale. I'll skip to the very end. We didn't have any change for the participants that have years service greater than 5. They were tracking appropriately to the salary scale. However, we did see for participants that had less than 5 years of service, their salaries grew more rapidly. So we're proposing a change where there's a split in salary scale just based on years of service. And as you can see, for the years of service less than 5, we're proposing a increase for those specific years. So it goes based on age. So in 2020, when they're 25, it's 6.75%, and that slowly decreases until they reach age 40, which would be 5.5% for the less than 5 group. I think out of all of our recommended changes, this is the one we are looking to see if there's any input on. So we'll pause to see if there's any commentary.
Is this non-union or is this overall?
This is everybody, yes.
I'm assuming these are pensionable salaries, not like base salary. This is using
Correct,
actual pensionable salary.
yes.
Is there a difference, union versus non-union? Like I'd assume we know what. But are vacation and overtime payouts going to increase with their service? I mean, like in my brain, I can wrap around like a non-union, and we talked about this, so I don't think I was thinking it when we met about it earlier.
It's okay.
Right, you hire a budget analyst, and they're great, and they get more raises early in their career than they'll get later in their career. But you hire like a cashier, and they're going to get the same raise that everyone in their union gets. So
Yeah, so we looked at, again, each of the job classes individually and the group as a whole. Our current assumption was the group as a whole. The individual groups weren't terribly out of line with each other, so we were comfortable still kind of maintaining one single assumption for the entire group.
These assumptions, we can get as nitty gritty as we want, or we can keep them high level. So it's based on comfort.
I'm just going to ask a dumb question to make it make sense in my brain. So is this basically saying that we've hired more high-level positions in the last group, that the salaries are that much higher than what was expected?
I think the assumption is probably more promotions causing higher rates of salary than the assumption.
Okay.
So that needs to be factored in as well, where, and typically we see that a little bit more early in service. And quite honestly, we also have new data coming with the Coriac's new system. So how accurate our prior data on this is slightly questionable, which is why we didn't go to 24% for less than 25 years of age and 12% for 25 to 29. But we have consistently seen that actual salary growth has been in excess of our assumptions, so we wanted to make some adjustments.
I would think if we're raising salary, so we're raising estimated salary increases for people with more than 5 years of service in our plan. But it's having a decreased
Yeah.
effect on our liability of 3.8.
Yeah. So just based on the way the liability is calculated, it's a little technical, but really what happens is the liability is decreasing, but then we're expecting it to grow faster over time. So because the normal cost now increases due to these amounts. So even though it has a decreasing effect in general, if you look further out in the projections, this would have, it would increase liabilities overall. If that makes sense. Just because accruals are higher throughout the year with this.
The net decrease in our liability
Correct. But it's going to be this year, but then normal cost, or how much benefits are coming into the plan essentially, that number is going to be larger year over year. So your liability is actually going to grow faster. So you're starting out a little overplaced, but you're going to grow faster. Yeah.
And we did also update some projections, and over the long term, total liabilities eventually will go up, but it's not anything crazy.
Did you have a question?
I do. So for the less than 5 years, in 2024, there was a bump because of raising of the minimum wage for non-union employees at the county. Was that considered? Because that is a one-time bump in starting wages. It's like you're not going to see that big increase again because now they're set to a rate of gradual increase.
Yeah, it was
Is
something.
that policy incorporated into this assumption?
So that isn't something we directly incorporated, but I'll just point to the actual numbers versus what we're proposing. We are proposing something definitely lower than what we were seeing, mainly because we were looking at, as Todd was mentioning, weren't sure exactly how accurate the data was prior to the new system, but then we also knew that there were nuances in the past couple of years with salary increases. So I would say that I would think our recommendation is still in line since we're being very conservative based on what we were seeing. Does that answer your question? Okay.
I think that ends the salary scale interrogation.
Wonderful. All right, we will move on to page 9 then. So for marriage characteristics, we take a look to see how many participants are married, and then in addition to that, what is the age difference between spouses? We typically see when two people are married that the female is younger than the male. So when we're taking a look at the prior assumption that was set in place, that was 100% of participants were going to be married. We're recommending to adjust this to what we see kind of just as a standard, and that is 70% of participants are assumed to be married. And then for the spouse age difference, once again, 3-year difference is pretty much standard what we see across all funds and pension plans. The current assumption is a 4-year age difference. If you flip back to the slide 3, for marriage characteristics, you can see that this one has a extremely small impact overall, but we still recommend these changes to be in line with industry standards. It's 0.005%.
Thank you. Are there any questions? Does the actuary just make the assumption changes? We don't have to vote on anything? Is that great?
Yeah. Unless there's any objections, we'll incorporate these, but we will definitely get back to you about the mortality for the above median.
Great. Thank you.
No problem.
And then next month, we'll see you with the actuarial report. Is that right?
Yeah.
A few things, yeah.
And other
Yeah,
exciting topics.
Update on the refund rate. And
Great. Great, thank you. Is there any other new business? No new business. Our next meeting is December 18th, 2025. And do I have a motion to adjourn? Is that how we adjourn?
So moved. Second.
Oh, and happy Thanksgiving.
Yes.
One of us is thinking about that. Have a nice holiday. And we do have a investment, so I'll call this meeting adjourned. We do have an investment and depository board meeting at 1:15. So if you're going to do a lot of mingling post-meeting, please mosey out into the hallway to do it. It's here, yeah.